Hello, chart watchers, and welcome to this Thursday, June 21st Market Watchers Live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we got the Dow Jones Industrial Average down, trying to set a new low for the 8th consecutive day. The S&P 500 also down about 9 points. By the way, the Dow Jones down 135 points. The S&P down 9, testing its rising 20-day moving average. The NASDAQ and the Russell 2000 still remain up close to their recent highs, but both are down today. The NASDAQ down 26 and the Russell 2000 down 8. 10-year Treasury yield down about 2 basis points to 2.91%. A couple of weak economic reports we'll talk about in just a minute. Volatility index is on the rise today. We saw a huge spike. It got up to about the 1460 level. Currently at 1383, which is up about 8% from yesterday's close. Utilities and consumer staples leading the market. That is typical on down days. We see money rotate towards defense. We're seeing it in the bond market. We're also seeing it in utilities and consumer staples. The dollar, however, is still up, challenging its recent high. This is the UUP. This is the dollar bullish fund. It actually is performing a little bit better than the dollar index. If you pull up the dollar USD, you'll see that we haven't quite cleared that late May high. I think that's a very significant level. Wrote about it quite a bit in my blog this morning. But the dollar is threatening to break out again. And you can see gold, the GLD, as a result, breaking down to new lows. I do not like gold. That continues. Energy, you can see, has actually pulled back. These are the two weakest areas. Energy to the downside, challenging the lows that we saw earlier this week. And industrials, XLI, following the Dow Jones, really been down just about every day here over the past 8 or 9 trading sessions and continuing to perform rather weakly. Okay, Erin, Thursday, June 21st. I think it means it's summertime, and it arrived here in Charlotte recently with 99-degree days this week. How are things going?
That's pretty crazy. Yeah, we've got warm weather, of course, arriving as well. But, so far, not too bad. It's just gotten in the 80s, maybe 90. So I'm still not melting just yet.
We both may want to move to the Netherlands. How's the weather in the Netherlands, Julius?
Crazy. I mean, we had 25 degrees. That's Celsius yesterday, and today is 12. So it drives me absolutely nuts. Yesterday, you can walk in shorts and T-shirts, and today you need a coat. So, I mean...
Is that typical? I mean, you see a lot of...
No, it's not typical, but it happens. It happens too often.
I was going to say, we could use a little 12 Celsius, because that, I think, is probably like around 60 degrees, something like that.
Yeah, probably. Yeah. I think 20, 21 degrees is yours, 72, something like that. So, yeah, you could be right.
It's pretty cold.
Yeah, it is.
Yeah, we may not want to start doing the conversion tables from Fahrenheit to Celsius.
No, let's not do that. You should move to Celsius so the rest of the world can understand you.
Yeah, we could move to a lot of things so the rest of the world could. Anyway. Well, you're going to be on today. I know you've got a presentation for everybody. And of course, Julius is the author and creator of the RRG chart. So it's always a pleasure listening to what you have in store for us. And we're going to get back to you probably in about 15 minutes or so, Julius. So hang in there.
Yeah, if anyone has any, pressing questions, just put them in the chat and I'll see if I can, pick them up during my presentation.
Awesome. We'll be back with you in just a few. Erin,
excellent.
Through the schedule and the agenda, and we'll get things started here.
All right. Yes, Julius is usually very active in the chat room, so feel free. The upcoming schedule, we're going to be doing Anatomy of a Trade tomorrow. It's been a while. Tom has a workshop going to come up on Tuesday, and of course, he doesn't know his subject just yet. And then we have some great guests after that on Wednesday. We have Scott Carney. On Thursday, we have Dan Russo. And then on Friday, we have Everything Stock Charts. So it's going to be a jam-packed week next week. However, today, as far as the agenda, as you heard, Julius de Kempenaer will be with us to talk RRG. And 10 and 10, the first symbol is Mimecast Limited, M-I-M-E. Finally, we're going to finish it off with our segment Under the Radar. So stay tuned for that. All right, Tom, I know there was a ton of economic news that came out today, so I'm going to hand it back to you.
All right, sounds good. Yeah, there was a number of reports that came out this morning First, we had initial jobless claims. Of course, they come out every Thursday morning, 218,000 versus the 220,000 that was expected. So a slight, I guess that was a little bit of good news, slightly below expectations. But the really big one was the June Philadelphia Fed Business Outlook Survey. The consensus estimate was 28.0, and I noticed the lowest estimate was 20, and the actual number came in at 19.9. So it was actually below even the lowest estimate out there. And I thought maybe we'd have even more of a push into the Treasury market, meaning that yields would drop quite a bit today. And we were down lower earlier. We got down to 2.89, which was about almost 4 basis points lower. But we have rallied off of those lows, and the overall uptrend continues here in the 10-year Treasury yield. At 9 o'clock, we had the April FHFA House Price Index come in, rose only 0.1%, market looking for 0.5% increase. And then at 10 a.m. Eastern, we had the May leading indicators come out. They rose 0.2%, the market expecting 0.3%. So really not very good economic news out this morning. And overall, I'd say the bond market and the equity markets both handling it fairly well. If we pull up the Dow Jones, we can see that the weakness continues here. The Dow has been down, I think, for the last 8 days in a row, or 7 days in a row. I guess today would make it 8 days in a row. And it's really been the tale of two markets, because we've got the Dow going down almost every day. And then when we pull up the NASDAQ and the Russell 2000, you don't see that over the last 8 days. We had a couple of days where we gapped down, but you can see all of these hollow candles. Every time the NASDAQ pulls back, it seems like buyers step in. And certainly the same holds true for the Russell 2000, where small caps have been up almost every day during this period. So when we pull up, one of the big differences, of course, between the Dow and, say, the Russell 2000 is that the small caps are not overly concerned with the trade war and the rising dollar. You got a lot of Dow Jones stocks that do business around the world, and some of them do more than half their business in other places besides the U.S. And as a result, you've got a rising dollar that eats into those earnings that have to be translated back into U.S. dollars. So the UUP, you can see during this 8-day winning streak for the small caps, the dollar has been on a tear again back to the upside. And it has also coincided with that Dow Jones slide over the last few days. So the dollar is definitely playing a role. And if you're looking at your individual portfolio and can't quite figure out what's going on, one thing I'd be looking at is to see whether or not your companies that you're investing in or trading are companies that are doing business overseas. If they're larger companies, larger multinational companies, many of those are not doing nearly as well as the ones that are doing business solely here in the U.S. or doing most of their business here in the U.S. And that certainly is what you get when you're trading a lot of the Russell 2000 companies, a lot of the small domestic companies. I mentioned that the XLU and the XLP were leading today with the market down. Defensive stocks have been on the rise. You can see utilities moving much higher, and over the past 7 or 8 days, while the Dow's been sliding, you can see utilities actually have been moving higher. Also, I think that the consumer staples area has really started to perform much better on a technical basis. You can see the 20-day moving average for the first time since early February. The 20-day moving average is back above the 50-day moving average. You've got to get a little bit of strength in order to get that 20-day above the 50, and we've seen that with consumer staples. Now, consumer staples are not consumer discretionary. We can pull up the XLY, and you can see a big difference here. Consumer discretionary is broken out above those January highs. And if we go back to that consumer staples chart, you'll see we're nowhere near that January high. So there's a number of things I think that are factoring in here in terms of consumer stocks. Number one is that traders just believe that our economy is strengthening. And when the economy is strengthening, keep in mind, 2/3 of GDP is consumer spending. So the question becomes, if you've got an economy expanding, which side of the consumer aisle do you want to be on? Do you want to be on that consumer discretionary side where you've got a lot of companies that sell the things that we want? Or do you want to be on the consumer staple side where you have companies that sell the things that we need? And clearly, I think traders have made their choice. They want the XLY over the XLP, and that bodes well for the sustainability of the current bull market, in my opinion. Let's take a look within consumer staples, though, because there is one group that has been performing extremely well. I know, consumer staples as a whole has been very weak, but if you look at the food retailers and wholesalers, since the dollar has been rising, we're also seeing a big rise in the food retail and wholesale space. Number of companies have been performing very well. Kroger came out this morning with exceptional earnings. They topped the revenue forecast. They came in $37.53 billion. The market was only looking for $37.25 billion. Bottom line, 73 cents versus 63 cents. And after gapping down back in March with its March earnings and struggling, going sideways mostly for the past 3 months, you can see Kroger getting a really big lift today on extremely heavy volume based on that earnings report. I suspect that we're going to see Kroger go back and test this January high around 31, and I believe it'll eventually break back out above that level. Also, another earnings report that came out today, DRI. This is Darden Restaurants. You can see a lot of sideways action. Earnings came out today. They just met revenue expectations at $2.13 billion, but bottom line, 139 versus 135 expected, and the market liked the results. You can see the very heavy volume today on this gap up. Opened at 102.51. It's continued pushing higher up to 104.43 here at last check. And if we pull up that relative chart that I like to use, you can see that Darden on this breakout, restaurants in particular have been moving lower, but Darden on the breakout now, this sets up DRI relative to its peers with a breakout now. We have a relative breakout on Darden with this move today. Darden also breaking out versus the S&P 500. The group has not been particularly strong, but consumer discretionary in total has been very strong. So if restaurants start to regain some strength, you do have a leader in DRI. I would expect this company to do very well if restaurants and bars begin to pick back up. The one downside to owning Darden is that right now the restaurants are kind of under the radar, not really being supported by the market. And even though consumer discretionary is getting more than its fair share, it's going to other areas like the retailers and not so much to areas like the restaurants. So DRI is certainly one to keep on your watch list. I think this breakout is very significant, but we do need to get some better relative strength in the restaurant space. I'm going to bring up the media agencies again. I've talked about this quite a bit, and we are once again challenging major overhead resistance. This has been going on for about 3 or 4 months, and I wrote about it in my blog a couple days ago, but I think that it's 23 times, and maybe the last couple of days, it might be up to 24 or 25 days now, where we have traded above 565 on an intraday basis, and we have yet to close over 570. So that's a lot of times. And anytime you get a major resistance level like this, when it does get cleared, it can be a very significant technical sign. So I think this is a group worth watching. A couple of stocks that I really like in this space, I'm actually going to save for that last segment under the radar. So I got a couple of small companies in this group that I think you might be interested in, and I'll talk about that later in the show. The German DAX, let's talk about the DAX here for a minute, because the S&P 500 tends to take some cues from the German DAX. And you look at it here and you say, well, so far it's holding support. Well, keep in mind that this does not get updated until the end of the day. The German DAX is actually, last time I was looking, was down about 150 points today and was trading at 12,550, thereabouts, maybe 12,540. And that would represent the lowest close that we've seen over the course of the past 7 weeks or so. So I do think that the German DAX, we want to watch this, because a breakdown here, and especially a continuing move to the downside, could tend to weigh on the S&P 500. And I mentioned also in my blog this morning, the S&P 500 from June 18th, I believe, until June 26th, has an annualized return of negative 26% since 1950. So this is a period of June, and really throughout the entire calendar year. We've talked about this many times. The 18th of the month to about the 26th tends to be a period of selling or profit taking or consolidation. It's not that we can't go higher, that time of the year, but we do typically struggle all calendar months. There are a couple of exceptions, but most calendar months anyway, we do struggle between the 18th and the 26th, and it is very pronounced in the month of June. going back on the S&P 500. So you can see here, really over the past few days, as we got into the 18th, we closed on the 15th last Friday at about 2780. And since then, we've now gone down about 1% over the last 4 days. This is typical. This is very typical for this time of the month, this time of the year for the S&P 500. And if the German DAX breaks down, that could put a little bit more pressure on the S&P here, as we have still another 5 days or so before we close out this bearish historical period. A couple of stocks in the news. Let's take a look at Thor, THO. This is, and I'm going to go into the relative chart because we've been moving lower. We made a breakout yesterday above this downtrend, which I think is fairly significant. This is in the recreational products area within consumer discretionary. It gapped up earlier today and it's pulled back, but I think this pullback could be an opportunity. It looks to me like maybe we're getting some sort of a bottoming head and shoulders, so maybe this is the right side of a neckline we're pulling back from. I think that rising 20-day moving average would be extremely interesting for a solid reward to risk trade on the long side. Thor Industries came out this morning and announced $250 million share repurchase agreement. So they got the breakout yesterday with increasing volume and then came out with another bullish, or at least some bullish fundamental news today. We got a big gap up. It's pulled back and it is slightly negative now, but I think that this is a stock that's broken its downtrend and could be poised for a much bigger push to the upside. In a similar light, HPQ. This is Hewlett Packard, or HP. They authorized an additional $4 billion for future stock purchases. Haven't made the breakout yet, but you can see we've been had a pretty strong June so far, pulling back near that 20-day moving average. A breakout above 2450 would be very bullish. And you can see that HP, relative to its peers, has been performing well over the past few weeks. Looks like maybe even breaking a relative downtrend. And the group, or the stock relative to the S&P 500, has done particularly well, trying to make a breakout above the relative high that was set just a few months ago. So HPQ looks pretty good. Another stock. Let's take a look at CACI. CACI raised guidance. It was either last night after the bell or this morning. I'm not sure, but you can see gap up today. Huge push, up 6%, continuing its move to the upside. And you can see on a relative basis, it is up and is strengthening against its peers. It's strengthening against the S&P 500, but the group relative to the S&P 500 has been struggling. So you got a great stock. You just unfortunately don't have a great area of the market. Still, I look for CACI to move higher. Yesterday, we talked a little bit about GE being pushed out of the Dow Jones. Well, WBA, which is Walgreens, will be replacing it. Walgreens Boots Alliance got the big gap up yesterday off of a downtrend. This could be a little temporary push to the upside, but I do think maybe on a pullback down around that rising 20-day moving average, that Walgreens could be an interesting reward to risk trade on the long side. One other company that reported earnings, and I'm going to turn things over to Julius. Micron Technology, after the bell yesterday, reported revenues of $7.8 billion. Market expecting $7.76 billion. So we got a nice little beat on the top line. Bottom line, $3.15 versus $3.13. Micron continues to trade in a trading range, 64 to the upside, and I'm going to say gap support down around 56 to the downside. This is an area I'd watch closely on Micron. Off of an uptrend, trending sideways, it's in a strong group. My expectation is that we're going to see a breakout on Micron. A confirmed close over 64 with heavy volume is what you want to look for here. Okay, everyone I know has been waiting for Julius's presentation. Julius, I know you got a lot of stuff going on with RRG. What do you have for everybody today?
Hi, Tom. Well, I want to do a little bit of a recap. Let me share my screen so everybody can see what I am seeing. There's my desktop. Share it. I want to do a quick recap on benchmarks on RRGs, because relative rotation graphs consist of two major areas, items. One is the universe, it's the group of stocks that we want to look at. And by the way, RRGs, they show trends in relative strength or trends in performance of multiple securities in a universe against a benchmark and against each other. A quick reminder, I'm sure you've all seen this before, but I keep running into people who say that it is showing performance, and that is not the case. It's not the case. It's not showing you performance as such. It's showing you trends in relative performance, and especially in markets that we see right now with, one day going up, one day going down, we can have situations. Staple sector is probably the best example. On the RRG, especially on the weekly, it's still very weak. It's in the lagging quadrant. But as Tom has pointed out earlier, it's a safe haven. On weekdays, people flock to the staple sector, and then you see positive performance in the staple sector for 1, maybe 2 days. But it's still in the lagging quadrant on the weekly RRG, and that's because the weekly RRG looks at the weekly trend. So please bear in mind that it showed that we're looking at relative trends, not a relative performance per se. What I want to talk to you about today is as I said, benchmarks, because we can play games with benchmarks, and they can significantly change the way an RRG looks. Combined with that, I want to do a quick word on open and closed universes. I pinpoint $1 as a special benchmark. It was one of the questions in the chat, but I already had it on my list, so that was a good coincidence. And I want to talk a little bit about asset allocation, using RRGs for asset allocation. I write about it on a regular basis. I've just written about it for the Chart Watchers newsletter. And we're going to show you that we now have a pre-populated group in the drop-down of the RRG chart on the site, so you don't have to do it yourselves. Let me quickly go to my charts, because benchmarks, and let's just start off with the asset allocation stuff that I'm working on. What I use here is a group of ticker symbols that all represent a specific area of the market. We got real estate, VNQ. We got LQD, which is corporate bonds. We got IEF, which is government bonds. We got HYG, which is high yield. SPY, obviously the US stock market. DGP, which is commodities. And then I've added $USD to my universe, which is the US dollar index. And I primarily did that because I started basically rereading or reworking my way through John Murphy's latest book, Trading with Intermarket Analysis. And what the project that I'm on is trying to get all the relationships and the intermarket relationship that he is talking about and is describing on an RRG, or use RRG to support those intermarket relationships. And this asset allocation RRG is the first result of that, so to say. While we're at it, I can show you that in the drop-down box, you see that the asset allocation group is now there, so you don't have to type in all these symbols yourself and save it as a permalink. You can just go to the groups and click asset allocation, and the RRG will be populated by the various asset classes that we have there. Now, before we dive into the analysis of this chart, I'd like to play with benchmarks a little bit more. If we move to the US sector RRG that we're looking at right here, you see we're all familiar with these 10 are now with real estate ETFs that track US sectors, and we're using SPY as a benchmark. Now, this is what we call a closed universe. And that's the reason for that is that all these sectors together make up SPY as an index. So everything on the plot is included in the index. That makes it a closed universe. Closed universes typically show a nicely scattered, evenly spread out RRG with a decent spread around the plot of all the various items on the chart. If we go back to the asset allocation RRG, it's an open universe because VBINX is the Vanguard Balanced Index Fund. that consists of 60% US equities and 40% US government bonds. So basically, the only two items on this chart that are included in the benchmark are SPY and IEF. So if I would basically do this, limit my chart to SPY and ETF, this is a closed universe. So here, by the way, it's a great chart. You just use these two ETFs and VBINX to answer the question whether you want to be invested in stocks or in bonds. And you can actually play the rotation over time of the relationship between stocks and bonds. And you can see that, for a very long time already, equities are, moving on the right-hand side of the chart and bonds are on the left-hand side of the chart. That's still the case. We'll go into a little bit more detail later. The fact that we are adding other asset classes, other ticker symbols to this group and compare them to VBINX means that we are stepping outside of our benchmark. So, for example, commodities or corporate bonds or high yield bonds or real estate are not included in the benchmark. But if we are running a portfolio, we can use those asset classes to beat our benchmark instead of just using equities and bonds, and putting them on an RRG and comparing them to that benchmark will help you pinpoint potential pockets of alpha that are not available inside the benchmark. Now, the other thing with a open universe, I can best show by, again, we have, you probably have seen that added all the members of the various sectors to the drop-down menu. So if you click on the S&P 500 sector ETFs, you get the ETFs themselves, so the sectors. Now, let's say that we want to look at XLP. It's interesting. It's an interesting sector. A lot going on there. It's been a dog for a very long time. And the fun thing is that I was yesterday, I spent pretty much all day at Robeco Asset Management in Rotterdam in the Netherlands. That's the biggest asset manager in the Netherlands. And I did 2 workshops for their portfolio managers, 3 hours each in the morning, 3 hours in the afternoon. And these guys are, super relatively orientated. They need to know what's outperforming. And it was a guy. One of the guys was the fund manager of a Staples fund, or consumer fund, they call it, the consumer fund. So, consumer staples, consumer discretionary, that relationship was very important for him. And I was talking to him and I said, can you, because Staples has been so bad. I mean, I can imagine that you just don't want to be invested in Staples at all. What is your possibility to do something about it? Guess what? His allowance, he was allowed a maximum of 10% cash in his fund. So this guy is running probably a couple of $100 million US in a consumer fund. And he knows that the staple sector is going down, but still he needs to invest 90% of his fund into that sector. So what is he looking for? He wants to look at the best stocks in that sector. And we played around with RRGs. And what we do here is we then bring up the staples sector against the staples index, so XLP, and then we look for stuff that's outperforming the benchmark, in this case, the sector benchmark, XLP. And Tom, I just heard you talk about Kroger, and immediately at home, this was the stock that we brought up this exact chart yesterday when I was talking to him. And one of the stocks that I said, this one really you need to have in your portfolio because it looks really good, was Kroger. And that was yesterday, my time afternoon. So look at what happened here.
Hey, Julius, would you buy a stock heading into its earnings? I mean, if you saw it yesterday and you knew they were going to be reporting earnings today.
I know your point about it, and I'm probably with you from a retail point of view. But this guy has no, that's not an issue for him, because if he buys something, he needs like 1 or 2 weeks to build his position to begin with. So buying into earnings or something like that, that's not something that these guys are worried about. Would I buy it from a trading perspective? Probably not. I don't know. I'm not so much of a trader. So yeah, it's a difficult question for me. but you're much more of a trader, much more of a swing trader, and I know you stand by your rule that you don't buy into earnings. And I've seen enough of your examples where it was a very good rule to not buy into earnings, but I thought this one was too good to pass on as an example of how you pick stocks, good stocks, in a sector that's underperforming like nowhere.
Yeah, well, I think, as far as that earnings comment, and I'll just make a quick comment, and
no worries.
We had Grayson Rose on here yesterday, and he was talking about having a trading system and just sticking to it, knowing who you are and what kind of trader you are, and then sticking to your rules. And so when I think about earnings, for me, it really comes down to what kind of trader you are. Obviously, if you're a long-term investor, you can't be worrying about earnings because they come out 4 times a year. And so, it doesn't really fit with a long-term investing strategy not to hold into earnings. But if you're a short-term trader where you tend to hold for maybe a couple of weeks to a couple of months, then earnings becomes a very big factor that you have to consider, because in the short term, if you're trying to make, say, 8 to 10% on a trade, and all of a sudden you buy a stock, goes into earnings, and you lose 20% the next morning, it takes a lot of positive trades to make up for that. So it's just a risk for me personally that I don't like to take. But again, if you're more of a longer term, as Grayson was talking about yesterday, he likes to see, relative strength, and he likes to ride it. And if you're going to ride that over long periods of time, obviously you're going to hold into earnings.
Yeah, I mean, that's totally true. I mean, everybody's got to do what they feel comfortable with. We got so many different flavors of traders: short-term traders, swing traders, long-term traders, scalping, intraday traders. I mean, high frequency, probably not on the audience right now, but high frequency traders, computer programs, etc. So I really believe that everybody should employ a strategy or apply a strategy that they feel comfortable with, that they know what it's doing, and they can more or less predict what's going on. So that's that. By the way, if you talk about Grayson, if you haven't read his latest blog, Stop Tinkering, I believe is the title, about you can overanalyze, but once you've got something, you stick to it and you start executing it instead of trying to what if. That's a great article. I complimented him on that because I really like what he wrote there. Going back to the benchmark stuff, we here now have again, this is a closed universe because we have all the consumer staple stocks and the consumer staple sector. And we can also put this against SPY. And now it's an open universe. And because, then I should put it on weekly. Now we only have a subset of SPY against the benchmark SPY. And we all know that staples as a sector was very, very weak inside lagging. And here you can see that the majority of the stocks inside the staple sector are inside lagging against SPY. So this is how you can play around with open and closed universes and different benchmarks. As long as you know what you're looking at, feel free to use anything, but please be aware of what you're looking at and don't make mistakes with that. Now, there is one, I call it a special benchmark. That's the $1 symbol, because so far and until now, everything that we've done here on RRGs is relative. We have a relative rotation graph, and for example, this one shows you all the sectors relative to the S&P 500. Now, what if your benchmark, and we have the poll up. Let me see what the status is of that poll. Oh, S&P 500, 76% looks at the S&P 500 as a benchmark, and only 11% looks at absolute return. That's interesting. You're looking for an RRG like this. This means that if you, for example, continue to hold XLK or XLY or energy for that matter while it's still in the leading quadrant, and the S&P starts to slow down or go down in price, and these sectors continue to outperform, you might end up in a situation where you are outperforming the S&P 500, but you're still losing money because the sectors that you hold. But the only thing is you lose less than the S&P 500. That's the relative play. If you are interested in absolute returns and you say, I don't want to lose money, I just want to keep my money and look for absolute returns, you may want to consider looking at $1 as the benchmark for your RRG. And what this will do, this will compare all the sectors to 1. So this looks at absolute return. It's now either up or down. And the center of the chart is now 0% return. And as you can see, the position of these sectors is still the same. The center of the chart has changed, and the trails have changed a little bit because now it has become a moving target, or basically a double moving target. Because if I add SPY to the canvas, to the groups, then you can see SPY here and the others around it. So if you draw an imaginary crosshair with SPY in the middle, that would represent the position on a normal RRG with SPY as a benchmark. Now, see what happens if we start scrolling through it. So let's go back in time and then max it out here. And let's play a little bit of history. Let's highlight SPY. Here you go. And now we plot through history, and you can see that SPY is obviously moving against $1, and all the sectors are moving against $1, but they're also moving against SPY. So the relative point is against SPY, so that's here, and you got everything against SPY. And in absolute terms, it's now moved against $1. So you can use this actually to get a handle on both the relative and the absolute performance, trends in performance at the same time. Just wanted to update you on this usage of $1 as a special benchmark. One of the other things that I've played around with, and then we'll start looking at the actual markets at some moves that we see in asset allocation or various asset classes. If you I think it's you have to be an extra or a pro user. You can use user-defined indices. And I've been playing around with that. And what I've created is, let me put that in a different chart to start with, is an index, and I call it 5%. And that's a line that grows at a rate of 5% per year. This one always goes up. So if you say, I'm not only interested in absolute return, but I want to make 5% per annum on my money, then 5% per annum is your benchmark. It could be. I mean, it could be an absolute return, and you want to make 5% or more per annum. Now, if I stick that at 5% in an RRG, then all of a sudden, everything is compared to 5% annual return, and I get an RRG. And this one continues to move up, and I can see which sectors are giving me that return. And you see that now everything is shifted to the right because the stock market in general has been doing very well. Most of the sectors have been beating that 5%. XLE, XLF, not very recently. This is XLY. Look at this. It's a daily. So if we move to a weekly, we got a little bit longer term picture, and then we'll have XLP showing up. Improvement, safe haven over the last couple of weeks. You see that coming up. So this is how you can play around with benchmarks and with groups, talking about open and closed universes, talking about different benchmarks, and you now have available the various drop-downs, pre-populated groups. Let's go back to asset allocation, which was the stuff that I recently wrote about, and it's always an interesting subject because if markets are moving around like they're doing right now, upswings, downswings, volatility increasing, I think it's always good to step back and see, take a big picture view and find out what's going on. And on the weekly, so the longer term trends, it's pretty clear that SPY, so equities, is doing well, and IEF or government bonds are doing not so well. So based on this relationship, on the weekly RRG, on the weekly charts, you got to prefer equities over bonds still. Now, at the beginning of the week, we had a few moves that, threw some curveballs at the market. And when I look at the daily version of this chart, you see some things that have started turning around. And that's not so nice, because what you see here is that, the improvement of SPY, as you can see here, the green one moving into the leading, has rapidly turned around and started moving into weakening and heading in a negative area. And IEF, and I'm going to take out US dollar because it, SPY. Take out US dollar because it's, come on. Well, here you go. Go away. Here is EIF. Now you can see it more clearly. IEF has started to move up very clearly now. So based on the daily, we now see the shift out of equities into bonds. Now the big question is this the beginning of a new and larger move, or is this one of these quick rotations as we've seen them so often over the past 2 years already, I have to say? Answer is, I am not sure. I'm going to watch this relationship very, very closely. And if we look at the, let's take the two charts of SPY and IEF. IEF. I need to learn this better. Asset allocation. Here you go. IEF. Yes. So what we see here is IEF. This is a chart that I've been playing around with for a long time. We had this weakness at the end of last year, a little rally, and we're now testing that 100 support level. This, to me, looks like selling pressure still. So if we break that support level, then this relative trend is gonna, continue downward, and IEF's gonna underperform equities. Equities are going to go up. However, we are setting up something that could become like a double bottom at this support area. And then we have quite a bit of upside in terms of bonds. We've got quite a bit of upside going to probably 105. Question is, what do we do now? I'm holding my horses. I'm still overweight equities. I like equities. The longer term picture looks good, but I'm on the edge because I don't like what I'm seeing here. I need to see this break below 100 to give equities that boost that they need. And if we look at the chart of SPY, which you probably can all dream, we had this very nice big triangle that we broke out of, which is good. That uptrend is there, is still good. But we've got this 278 level that's becoming quite a bit of resistance. So we really would like to see SPY going above 278, 280 probably to be sure, and continue its way up, or things will change there as well. And the one thing that worries me a little bit is the fact that relative strength broke out of its channel somewhere in March, April, in the red shaded area. The RS ratio was at extreme level, so it wasn't a big surprise that it was coming down. The uptrend is still there, but if we take this trend channel as the trend channel in relative strength, then we had a breakdown. The old support is acting as resistance already a few times. Can we break these previous highs? We need to break those previous highs to continue that relative uptrend. It looks pretty good for now, but if it can hold, I don't know. So for the time being, still overweight equities over bonds, but very, very careful and very, very cautious to monitor the short-term situation, whether something is going the other way around. Do I have 5 more minutes, Tom?
Yeah. Can I ask you one question though about that while you're talking about the relative?
Of course. Yeah.
Because you show that breakdown of that channel versus the VB.
VBINX.
Yeah. Show that breakdown in March, and that was just about the time the dollar started to sprint higher, and we've seen a lot of relative outperformance in small caps. So I guess, when you're looking at this and you're saying you're drawing the conclusion about equities and whether or not, you want to be in equities, do you break down the large cap S&P versus, say, the smaller cap Russell 2000 to see how they're performing? Because it could just be reallocated.
You are such a great host. I have not looked at it, but we can do that because here we have size segments, I think. I've broken them down a few. So this one looks at large cap, mid cap, small cap. And I use the Dow Jones sector family, index family to do this. So here you go. This is your small cap. Small cap super strong, and you don't want to be in large cap, and so small cap is the place to be. That's very clear. This is here's your small cap. Sorry, here's your small caps. The center is the Dow Jones US index, and here is mid cap, and here is large cap. And we can I have another one that I've set up, and I call it all in one, because you can also split these sector indices in value and growth. So if we look here, fit. Let's see. This is US growth large caps. So in large cap, there's still large cap growth stocks. That's super strong. And then it's growth, and you got small cap growth following suit. And small cap, that's the whole small cap. So this is growth and value together. Now let's see where value is. Small cap value. Okay-ish, not fantastic. And in the lagging quadrant, we got value. So if you want to make a breakdown, growth versus value, it's very, very clear that you want to be in growth still and not in value. That's a very clear message here.
Yep, and with small cap growth kind of being the leader there.
Exactly, yeah. So large cap growth still outperforming, but it's trailed by small cap. But that's probably because we've had such a strong run in the S&P 500 in the large cap stocks. But small cap is very rapidly picking up. So yes, you are absolutely right. Small cap is a very interesting area of the market right now.
Why don't we do this? Why don't we bring up that poll, because that was a pretty important poll that we wanted to kind of get.
Yeah.
See, what everyone uses as their benchmark. And while we're doing that, Erin, if there were a couple of questions in the room, maybe that Julius can talk about while we're looking at this poll.
Well, I know as soon as you pulled up some of the user created indice, the 5 PCT, people are wondering if they can get a hold of that. Is there a way for you to?
Yeah, of course, I'll share it. You know what? I will. I write a blog on it somewhere. Probably going to post it on the RRG blog because I've got access to that. On how you create an index like that. That's not a problem. I'll show you the Excel sheet.
All right.
With the steps and the stuff and how to do it. It's actually quite simple.
Okay.
Yep, I'll do that.
And then finally, what's your favorite position on the RRGs? Like, do you like it to go from weakening? We
can have a long answer and a short answer on that one, and let's stick with the short answer. This is an area where I'm still doing a lot of research, but for now, I like stocks or securities that are inside the weakening quadrant, but turning up into a positive RRG heading. And RRG heading is like on a compass between 0 and 90 degrees. And if you translate that to normal language, these are securities that have started to outperform their benchmark. So the relative downtrend has turned around into a relative uptrend, and it went through its first corrective move and then started to pick up again. So you're picking up the second or the third leg in the relative uptrend, where you clearly have a lot less risk than when it's the first turnaround, because you still have to, wait and see if it's a real turnaround or just one of these attempts to turn around, but it never materializes.
Right.
So, yeah, I had one other question, but we're at 1850, I see. Do you want me to answer? I've got one question that I can answer. I can do it now or maybe at a later stage. What do you guys want?
Yeah, I mean, if you've got a minute or two.
Okay. So one of the questions was, how can you use RRG for short and medium term swing trading potentials according to strong sectors? Basically, what I just showed you in the drop down box is going to help you with that. Oh, I don't have the screen anymore.
Oh, you can go ahead.
Yeah. Yeah, can I do that? Thank you.
Grab it.
Yeah, I just wanted to kind of see what the results were while we were talking about the benchmarks.
Yeah, no problem. We've seen that, so you can prepare that. Let me show you another trick that I always use, and the last time I did it, people seemed to like that. I split my screen in two. Take this one, and that has nothing to do with stock charts. It's just a Windows thing that you can do. You can just split your screen in two areas, and then I bring up an RRG here, and I can do my stock analysis right here. Now, if I bring up S&P 500, we'll do it very quickly. XLY, XLK are the strongest. So XLY here looks to have potential. So I'm gonna assume, or I know that XLY is one of the stronger sectors. Then I can go into the groups and drop down to XLY, discretionary sector, and show the members. If there are more than 50 stocks in that sector, we'll only pick the top 50, because that's the hard limit of the number of stocks we can show on an RRG here on stock charts. It's very crowded, so I'll make that 3. And then I'm going to basically quickly browse, and this is you highlight it in the table, and I'm now pressing my control key and my down arrows, and I can very rapidly move through all these things. You can even make a tail a little bit longer to see it. And then this is one, I'll see it immediately, because this one also pops up on the RRG of the Dow Jones. That's Home Depot. And what I then do is I go to my other screen and I say Home Depot, and you pick one of your charts, whatever you like to work with. Let me bring this so it shows the whole chart. Here you go. So here's your Home Depot chart. And you can do your analysis and pick it, etc. I was looking at Home Depot because I thought that I was seeing something that could look like a small bullish flag here. We really need to break out, but if we push above, let's say 201.60, 202, with an RRG position like this, I like it. So just a very quick way of how you can interact between your RRGs to find trades. So this is the weekly. I would always check for a short-term or a swing trading the daily version of that chart. See where Home Depot is positioned on the daily RRG. Where are you? Well, of course, it's coming down here. Great, but it's turning very rapidly. That's actually just what I said. What do you like? If it's in weakening and it turns up, then yes, please. And I guarantee you, when Home Depot starts to rally out of this consolidation pattern, then this will turn around and move into the leading quadrant. And we're already in improving, heading towards leading. So couple of things are lining up. So answer to the question is, use the RRG to pick the strongest sector, then drill down into the sector to find the individual names, quickly toggle through all the names on the table, find something that appeals to you, either in weakening, turning back up, powering into leading, etc. And then check your normal, whatever chart you like to use. If you want to use MACDs, PPOs, PMOs, stochastics, whatever you like to use to confirm what you've seen, and then set up your trade.
Awesome. Another great discussion, Julius. Always a pleasure having you on here going over the RRG charts. I think it gives our audience another opportunity to see these RRG charts, how you use them, and to better their own trading based on that. So always appreciate you coming on here. No
problem. I'll be back next third Thursday. I hate that. Third Thursday. Whose idea was that?
It wasn't mine. I didn't do it. It had nothing to do with it. All right. Great having you, Julius.
No problem.
And we're going to see you at ChartCon soon.
Absolutely.
And I do know you usually stalk in the chat room. So if
I'll be around. No problem.
All right. Excellent. Okay. So let's go ahead and get started on that 10 and 10. I'm going to just quickly put that RRG up since we have Mr. RRG here. I was just looking at a few of these in the weakening category. Of course, we have so many that to look at, so it is a little bit jumbled. But I'm going to just come over here and let's see, get this in here more to the weakening. So just looking at this, going from weakening and starting to move back up, there are a few that look rather interesting today. So we'll cover some of those more than likely. But let's go ahead and get started. Tom, you have Mimecast, M-I-M-E, to start.
Okay, Mimecast, I think is, first of all, got a great uptrend in play. The only problem I have with it maybe is we got a little bit of negative divergence here. So the momentum appears to be slowing just a tad. Yesterday's volume on the breakout, though, was pretty strong. So you got some mixed signals. Overall, I do like this rising trend, though. But here's your higher price. Here is the PPO. So you can see that momentum appears to be slowing as prices move higher. But this was the volume. So this is the mixed signal that I'm getting. Volume was pretty strong on this breakout. And usually when I get that, I tend not to pay as much attention to that negative divergence. You can see we pulled back into the gap support zone, starting to bounce back off of it. Another breakout, I think, above about 46.25, getting back up above today's open, I think would be bullish. Volume trends here are strong in this trend. And I guess maybe the other thing that would be nice to draw here is this trend line that we have seemed to be continuing to ride higher, along with the recent lows as support. So I'm going to say to the downside, 41.42. This area right in here, got the 50-day moving average trend line support and price support all coming together. And to the upside, we wanted to just get a breakout above where we opened today. But I like the stock. We might see a little consolidation, but I expect it to go higher.
All right. And the most popular request in the chat room for 10 and 10 by a mile, I'd say, is Boeing, B-A.
Yeah, Boeing has been under some pressure. Along with the Dow. It's been leading to the downside. The industrials have been pretty weak. And as a result, Boeing has been under some pressure. A lot of this has to do with the trade war, the fear over the trade wars. Personally, I think it's overblown. I think it's an opportunity maybe to accumulate Boeing. Technically, I think the level to watch continues to be 310. To the upside, the recent high around 370. To me, this is a trading range that we continue to be in. Very heavy volume, though, recently on the selling. So it could be in for some more short-term selling pressure. Closer you get down to the 310, 315, 320 area, though, the better I like Boeing.
All right. The next one we're going to go with, it looked pretty good on the RRG, is going to be RRC. And that is, let's see, Range Resources, Energy, Exploration, and Production.
Yeah, there are a couple things I like about this stock. First of all, it had been downtrending for quite some time. I think we could probably draw, connect some lines right in through here. But, essentially we had been printing lower highs and lower lows for many months. And then we broke out of it, started moving higher. saw a little bit of volume coming in. If there's one downside to this breakout, maybe is that it could use a little bit more volume. But technically, when you get an uptrending stock like this, pullbacks I like to look for, testing that rising 20-day moving average. And I think you can see here that this has been a pretty solid push to the upside. So as long as we continue to hold that rising 20-day moving average, I would feel pretty good about RRC.
Okay. The next one is for our Canadian friends, SunOpta. It's in the industrial sector, soy.to, soy.to.
Okay, another one that I think looks pretty good after breaking a downtrend. This one does have some pretty good volume trends, although the overall volume in the stock is somewhat light for me. So I don't think I would be trading it. But just based on price action, I think you can see here, again, we've got that downtrend that was clearly broken. In this case, you can see a very strong candle with heavy volume coming in to support this breakout of this downtrend. And then since, what you want to see, and I always talk about, after it looks like we're starting an uptrend, it should begin to act like an uptrend, which is bouncing off a 20-day moving average test. And that is what we're seeing. Volume trends here, again, volume is fairly light, but the up days, the volume is much heavier than the down days, and we clearly are trending up for this at this time. So I like the stock. I think that the next step to the upside is going to be to challenge that late October, early November high. So I think this one's got room maybe for another 10% up to about that 1220 area.
All right. What do you think of natural gas, UNG?
I've talked about this one before. UNG, natural gas, I never get it right. So whatever I come up with, let's just go with the opposite.
Yes, amen, brother. Same with me.
It's acting pretty bullish here in the short term. Longer term, I mean, you can see it's just gone nowhere. But it has been riding on weakness along that rising 20-day moving average. So at least in the short term, I would be okay with it. Here you can see the tests that I'm talking about. I mean, multiple times that we have seen the United States Natural Gas Fund pullback, hit that rising 20-day moving average, and then bounce. We did clear above about 2340, which was a significant resistance level after the big drop. We got a reaction high to 2330, 2340. Sideways consolidation broke out, and notice that also has been holding a support. So I'd say as long as UNG remains above, say, 2330, I'd be okay with it. But again, technically, this one to me has really struggled, at least based on the techniques that I use to look at charts. So I would personally wouldn't do anything, but these are a couple of the levels maybe to watch as we move forward.
Okay, next up will be, let's see, IQ. This was actually a very requested one, an internet stock, IQ.
It doesn't have a big, long history, so that's about the only thing that I would be concerned about here. I normally don't trade stocks that don't have much of a history, but clearly there's an uptrend. I don't really need probably to point this out, but it's been moving straight up, and you can see here that it has probably got, I mean, it's down 11% today, and we still haven't even gotten close to the 20-day moving average, which is down probably another 12 or 13% from current price. 20-day moving average, I would suspect, is going to hold, but you can see the volume picking up to the downside. A lot of folks getting in up in the mid-40s. They start panicking when you get a push back down to the downside. So maybe what to look for is an intraday move below the 20-day and then watching it come back up above the 20, and then maybe use an intraday stop at that low beneath the 20. That might be one way to trade this, but without a whole lot of history, it's difficult really to make too many predictions about the stock.
Okay, let's see. Next is Iron Mountain. It's a specialty REIT. I'll be talking about that a little bit in our next segment, actually.
Is that IRM? What is
yes, that? IRM, I'm sorry. And I wouldn't be talking about this symbol, but I want to talk about REITs when we get there.
Okay. Yeah, I mean, we broke out just recently, pulled back, trying to make another breakout. One thing I would watch, because we were on a downtrend for a while, we broke out above this 34 level. It should have taken off at that point, came back down, pretty heavy volume, and now it's doing it again. Watch for a false breakout. That would probably be my best suggestion here, is that we had that prior high, these highs coming in. You can see the first one over here at 34, multiple tests at 34, couldn't get through. Then we finally get through and look, the volume doesn't even pick up. We pull back, we fail. Be careful if we leave a long tail above 34.5 and come back down. So that would be the other level here that I'd be watching. If we leave this tail completely above the resistance around 34.50, we could be setting a short-term top. So and then to the downside, I would just watch the trend line connecting these three lows.
Okay, another popular one from biotech, Intercept Pharmaceuticals, ICPT.
Yeah, I talked about a number of biotechs the other day, and I think Intercept was one of those that I talked about. Really nice move here to the upside. I think breaking back out above 75 was really important on this stock technically. So I'm just going to annotate that quickly at this level right here. You can see after the gap down, look at the reaction high coming up to 75. Took many months. We finally got to 75, continued trending higher, and then finally we make the breakout, and we did get volume spikes here to confirm this breakout to the down or to the upside. So now I would just be simply watching that rising 20-day. I think it should hold. It held the last time. Any kind of a move back down into the upper 70s, I think would be a great entry point.
All right, next one from the materials sector, Chemico, CCJ.
All right, CCJ, let's take a look here. Yeah, a little weakness here in the last 5 days. Just trying to look to see where I would consider maybe a stop and an entry, because I do like the uptrend here. I like the volume trends. One thing maybe to watch would be this trend line that we have seen now over the course of just the last few months. But right there, I think that would be an interesting area. If we pull back, maybe start building a position around 1090 and build it down to 10.25. I'd be careful if you lost 10.25, because this is a nice pattern, rising high, or higher highs and higher lows. So a move below 10.25 ultimately would be my problem, especially if the volume was heavy. But I think this one's trending higher after many months of consolidation. I think it goes higher.
Okay, utilities sector, Verizon, VZ, and that'll finish it off.
Okay, Verizon, I believe, got an upgrade yesterday or the day before. It might have been on one of these days with some big volume. Look at the chart. I mean, I just look at a chart. It's in the kind of utilities area, telecommunications, very defensive oriented, and it's not really doing anything. So I'm a momentum trader. I'm going to pass on it. If I had to annotate something, I don't even know what to annotate here, to be honest. I guess maybe most of the trading recently has taken place probably kind of in this range. I mean, we have a couple of outliers here. We break down, come back up, break out, come back down. But really over the most of 2018, certainly since early February, we've been trading in a pretty narrow $2-3 trading range. And we're sitting right in the middle of it right now. I just don't see anything to do with Verizon, so I'll pass.
All right. That completes the 10 and 10 to 1. And here are the symbols that Tom went over today. I will get these up in the Market Watchers Live blog. You just go over there to the Market Watchers Live blog, click on it. You're going to see the Market Watchers Live chart list link at the top, and it's also in all of our MWL recaps. So we'll be right back with our final market update after this message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
And now for our final market update. As you can see, most of the markets are down today, with the Dow right now right at intraday lows. We can see that the S&P 500 is also getting ready to challenge intraday lows just below 2750. We have the NASDAQ is coming back. It came back, but we're now getting back towards those intraday lows like we're seeing with the S&P and the others. You know, mid-caps not getting hurt quite as much. They are down today, but forming an intraday flag, so that could be interesting. Russell 2000, same sort of look, big drop down in the morning. Right now down 12.61 points. And the TSX also suffering somewhat today at intraday lows. We have the treasury yields have been down most of the day, started to make that return back up, but we're back down to 2.904% for treasury yields right now. Commodities are lower. We are seeing USO mostly unchanged. And so, you know, commodities not doing well despite USO, you know, not doing great. UUP is down right now. We're about heading back down though to those intraday lows. Gold is making a little bit of a resurgence here after a gap down. Still down 3 cents for GLD at 120.24. VIX is currently on the rise. Looks like it's at its high intraday high for the day at 14.51. So there does seem to be a little bit of concern out there currently. Tom, I'm not sure if you had anything you would like to add, but that concludes my portion of the final market update.
I just want to highlight one thing. You know, we were talking earlier with Julius, and he was using on the RRG charts the S&P 500 as a benchmark. And the poll, of course, showed that just about everyone in here uses the S&P 500 as their benchmark. I use it as my benchmark. And so I thought what I would do is just show a couple of key things to keep in mind as the dollar rises. Now, we are up against major resistance right now on the dollar. This chart only goes back really since the beginning of the year. So we can't see, but back late last year, we did have a top at about 95. We went down a little bit below, came back up, hit 95, went to a lower low, and then came back up to 95. So just picture a long-term or a longer-term bottoming reverse head and shoulders. And if the dollar index breaks above 95, I think that could send the dollar quite a bit higher. The reason I want to just talk about this just for 1 second is that when the dollar is moving higher, check out what happens to the Russell 2000 relative to the S&P 500, and then check out what happens to gold relative to the S&P 500. Part of the problem with gold is that it has lagged the S&P for many, many years, going back to about 2011. And with the exception of the first 6 months of 2016, gold has been a horrible investment relative to that benchmark. So just keep in mind, if we get a breakout on the dollar above that 95 level, I think small caps remain in play, should definitely be overweighted, at least in my opinion. And gold, on the other hand, should be ignored. That's really all I wanted to add. Just kind of build a little bit on what we talked about earlier with that bench, you know, the S&P being our benchmark. So let's go ahead and move into that final segment, under the radar. This is a segment that we've gone over a few times. We've had it on here a few times. But what we want to do is to feature some stocks that maybe you haven't, maybe haven't come across your radar screen that could be being accumulated with heavy volume. Maybe it's in a nice pattern, something that just kind of appeals to us, and therefore we want to share with you. So, Erin, what under the radar stocks do you have for everyone today?
All right. Well, I wanted to first show a scan that I ran just recently here in order to find some of these under the radar stocks. And, I'm not going to go over the actual, it's usually my regular PMO scan. I simply changed it so that the scooter value wouldn't be above 75, but would be between 60 and 80. And so when I got my scan results, let's see, go ahead and run it. Okay. So what was interesting when I got my scan results is when you look at what really came up, look at all the REITs that came up. I really found that interesting. I only am going to show one of them that I liked, mainly because I know that, we're talking about interest rates rising. I'm not so sure we're going to see that much great action out of REITs, but it might be somewhere you might be interested in taking a peek at in the very short term here, because they are coming up showing a lot of momentum. But let's go ahead and get to the stocks that I actually picked once I went in here. And as you can see, ended up with some cyclicals, some financials, and actually an electricity and utilities. And that's certainly a place that not everybody is looking at right now. So I wanted to show this. And yes, we've already been, you know, really in a nice rally, but it looks like we're ready to continue that run. And we could see prices move, you know, at least to challenge this 56 area. When I looked at this earlier, it was stationed above this overhead resistance. So I looked at this and, you know, we might be looking at something under the radar as far as one of the utilities that I was interested in. Let's go ahead and go back. And here was the REIT, Life Storage. This was the one that I was looking at in particular. All right, nice yield and dividend here too, just to note. So we were right at overhead resistance, and the PMO is starting to poke back up. I thought the OBV looked pretty healthy, and you can see the scooter is now starting to move into that hot zone. And if you go to the weekly, I believe that was the other place I was looking, you can see there's a lot of upside potential here before you get to some serious overhead resistance. And I would say that's, you know, at this high, we had that multi-year high. So I think there's some opportunity here. It is in the REITs, but it's a specialty REIT. So I thought that one looked pretty interesting. I'm going to show you a credit income fund, PIMCO. And this one, we did get the breakout. And you can see the PMO is just ready to get a positive crossover. It's not particularly overbought at this point. So there's some good momentum traveling with this. And you can see a nice setup of the EMAs. So that's also positive. And I think this was another one. You might want to look at that weekly chart as well. So we're getting ready to hit, you know, we're at these all-time highs for this credit income fund. But notice that, you know, we've got the PMO buy signal. We're still moving upwards on that weekly PMO. And it's, again, far from being overbought at this point in time. Let's see. This one was requested by one of the viewers, and I suspect because it came up on one of the PMO scans. So I thought it would be interesting. It came up on mine, obviously, and so that's why I was looking at it. Look at the big scooter move here. I liked the scooter move. That was one of the things that got me on this one. And, you know, momentum is starting to move to the upside. You can see we had I'm going to point you to that thumbnail. You can see we had all of these EMAs pretty much braid into the negative configuration. So I would certainly want to see a breakout above this 200-day EMA. But I think this one would be worthwhile to watch to see if it can get to that overhead resistance. I think it certainly has the momentum at this point building. And you can see the last time we got a similar signal at that same level, we had quite a move after that. So I thought this one looked interesting in the financial sector as well. And like I said, I know that was requested. RRG. There we go. This one is that utility that I was talking about earlier. And, you know, again, we're hitting that overhead resistance. I think I covered that, so I'm going to pass on that since we just looked at that. All right, here we have a marine transportation and industrial. Really nice break here above. And, you know, we did do this earlier in June, and it didn't quite work out. But I like the fact that we are trading above it right now. We could very well close above that area of overhead resistance. And, you know, $19 seems perfectly attainable, especially when I look at this PMO setup, the fact it's getting ready to turn back up. And you can see OBV volume reading is now higher than we've seen since April. So I think that is also a positive to consider as far as an under the radar stock. I did find a biotech, and this one would certainly be considered under the radar because it's under overhead resistance that has posed some problems. This was a really nice support area until we broke down, but we did find support here at that 200-day EMA. Excuse me. So I would be watching to see if we can't get above that overhead resistance, because if we can get above that overhead resistance and get that PMO to really start to make its move, look at the OBV is looking pretty good. So we have some accumulation probably going on here. Get that breakout, and I think upside potential at a minimum would be in this area of overhead resistance at 16, but that would be about it. And I think I covered all these others. Rainier Holdings, I think, was the last one. And you can see breakout above this short-term declining tops line. It's getting ready to challenge this intermediate term declining tops line, but you can see that momentum is starting to build. You can see the scooter moving up. If there's something I wouldn't like about it is the setup of the OBV. But I thought this one could be interesting just because we did break out of, break above a short-term declining tops line. What do you have, Tom?
Okay, I got a couple of things. I'm going to take a look at a couple of different areas of the market. First is the food retailers and wholesalers index. And I talked earlier at the top of the show about, taking a look at maybe some bottoming stocks in a couple of somewhat interesting anyway, industry groups. Now here, the food retailers and wholesalers, this is a 3-year weekly chart. And you can see back at the end of last year into the beginning part of this year is where the strength really began. We did break out above multiple tops here around the 340, 350 area. And after we broke out, went up to almost 400, we pulled back to 350. And now look at us moving back up and breaking out again. So this is a group, it is in consumer staples. So while it doesn't, it isn't in the best sector, it has clearly been drawing a lot of the money that is in that sector. So with that money rotating into this industry group, I thought I'd pull up a couple of stocks that have been struggling for a while, but could be on the verge, at least in my opinion, could be on the verge of making a pretty big turn here. So first, let's take a look at GNC. GNC, definite long-term downtrend. Those of you who really like to try and catch a stock, maybe as it's starting to make a turn, this is one that at least is beginning to look a lot more bullish to me. You can see throughout much of this downtrend, we rarely got above the 20-week moving average. Now the volume's starting to pick up. We've gotten back up above that 20. This is one to kind of keep an eye on. If the group is strong and money continues to flow into the group, you would think the GNC showing some bottoming signals perhaps will get it more than its fair share of money moving forward. So these are a little bit more flyers and certainly under the radar because they're not showing any relative strength for sure. But it does look like maybe we're beginning to bottom. And the fact that this is a small company and small caps are outperforming, notice that over the past 2 or 3 weeks is when we've begun to see some pretty nice strength here in GNC. So this is one maybe that could be bottoming. Watch the 20-week moving average. Goes back down, closes below the 20-week. I would probably ignore it. SVU is the other one in this space. Also has been downtrending. This one's been showing a little bit more strength. And really, ever since the dollar bottomed back in February, we have seen some serious outperformance. SVU's been up about 50% in the past 3 or 4 months, and yet still way below where we saw it a few years ago. So it looks to me like this one's gaining strength and has been under the radar. Pull back to test that rising 20-week would be awesome. The other index that I wanted to look at was media agencies. Now, when you look at this, there's no question that 590 is going to be a really important level. That was the reaction highs back in 2017, late 2017, again in early 2018. So you've got price resistance, you've got the trend line coming in, both at around 590. If this group goes above 590, I think that it has really turned the corner and it is a group to pay close attention to in the balance of 2018 and into 2019. But for now, let's take a look at the short term here. If we look at the daily chart, this is the one where I was talking about all of these tests coming in, 565, 570. If we break above 570, that would be your first clue because we have failed so many times here. Second clue is that 590 level that I just talked about on the weekly. Keep this group on your radar. If we were to break out, there are a couple of stocks I think that look pretty interesting. MCHX, this is Marchex. If there's one bad thing, it's the volume. I'm bringing it up because I like what I see on the chart. I wouldn't buy it because of the lack of volume. But after sideways consolidating here, we have already seen a breakout on increasing volume. And again, it's a small cap stock. Knowing money is rotating into this space, I think makes MCHX look pretty nice. And then the other one is NCMI. Another one in the media and agency space. Check out the kind of bottoming formation here. Made a breakout above 7.5, pulled back, tested that area, and then just broke out again. Very nice volume trends here over the past 6 weeks or so. And if we stretch it out onto a weekly chart, I think NCMI, you can see multiple tests between 7 and 750 off of this downtrend. We have now broken through, starting to see increasing volume. I wouldn't be surprised to see this one go back up and test the area where it broke down from, which is $10. It's at 8.25 right now. So if the group breaks out, I think NCMI and MCHX are two stocks to keep on your radar. Okay, that is it for the under the radar segment. We'll bring up the summary, go over the stocks that Erin just discussed for you using her PMO scan. And she was looking at the scooters between 60 and 80, came up with a number of interesting candidates for you.
Thank you.
I took a little bit different approach, looking at a couple of industry groups that could be very interesting. One, I think, already is. I think the food, retail, and wholesale group is already very strong. And so there were a couple of potential bottoming stocks there. And then the media agencies is one I'm waiting for a breakout. A couple of interesting small cap stocks there as well.
Yeah, what do you think of the REITs right now? I did find that really interesting that a lot of them are picking up momentum. Somebody in the chat room was mentioning that, you know, they could end up being stronger if we get the higher inflation.
Yeah, well, they certainly would benefit from inflation. Real estate would benefit from that. So the REITs would do well there. The problem I have with the REITs is just, I think interest rates are going higher, and you got a lot of folks that are interested in the dividends.
Right. And that's kind of where I was on there. But I think it was interesting though, when I do these scans and I end up with, you know, more in one sector or industry group than another, it does to me tell me something, you know, when I'm looking at that, where I might want to look where the strength is. But yeah, I'm a little bit gun shy about the REITs as far as actually getting in and investing them. But I also know longer term, they look pretty good still.
Yeah, they're a great long-term investment. For me, from a short-term trading perspective, in that scan you had, there was another grouping within the financial space of a number of stocks, and they were in the banks.
Banks, yes.
And I'm much more bullish the banks. I think that eventually the banks are going to rebound based on the fact that we are going to see higher interest rates, unless I'm wrong about interest rates. If interest rates don't go up, then I think, you know, they'll continue to languish. But I think the dollar's going higher. I think as a result of rates going higher. And so not only do I like banks, but I like the smaller to regional size banks.
Yeah. Okay. Good to know.
Yeah. So yeah, it's kind of a crazy couple of weeks though, because we've been seeing probably more bifurcation in the market than I can ever recall. I mean, the Dow Jones literally is looking to drop for the 8th consecutive day today. And yet the NASDAQ seems to want to go up and set all-time highs every day. So it's been a strange market.
It definitely has been. And Julius, I don't know if you're still there, but it was great having you on too.
I am here. I've tried to answer as many questions as I could in the chat box, but I see that some of them are already being deleted. So if you had a question, go to the chat box and see if you find your answer before it's been deleted.
All right.
All right, there you go. You got the upcoming schedule there. I want to thank everybody for being with us today, especially a shout out to Julius for joining us again today and going over the RRG charts and how you can use those. Remember to complete that survey as you exit, if you don't mind, especially, you know, give us some feedback on the RRG. We'd love to get that feedback, and also hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We'll see you back here on Friday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.